Good morning, good afternoon, everyone, and thank you for joining us today. I'm Irina Gorbach from Crystal Intelligence, and I'll be moderating today's session. Today, we will be discussing CARF and DAC8, but from a slightly different angle. Rather than focusing purely on regulatory requirements, we will explore what these frameworks mean in practice, particularly how they impact user transparency, how they reshape identity and data collection, and how they connect tax, AML, and investigations. Because what we are really seeing is a structural shift. We are moving toward a model where the same user-level data is used simultaneously for tax reporting, compliance monitoring, and financial investigations. And just before we dive in, we would like to quickly understand who we have with us today. We have a poll question here. What's your primary focus in relation to crypto compliance? Okay. Compliance and IML. Yeah, obviously that was expected. So we have the majority of our audience is from compliance and IML, 21% is tax reporting. Also, we have with us investigations, law enforcement, 10%, and some product operation people. Great, thank you. That's very helpful. Actually, it gives us better sense of the room and will help us tailor the discussion to what's most relevant for you. So let me quickly introduce our speakers. We have Colby from TaxBit, we have Anamaria from Transak, and we have Emeka from Sumsub. So I let speakers to introduce quickly themselves as well.
Okay, I'll jump in. Good afternoon, good morning, good evening, everyone. Thank you so much for joining us. My name is Colby Mangels. I'm the Global Head of Government Solutions at TaxBit. And up until about 5 months ago, I was actually working at the OECD, where I spent about 7 years working on both the development of the crypto asset reporting framework, so the framework that we'll be discussing today, as well as global anti-money laundering standards on virtual assets from the perspective of the Financial Action Task Force. Very happy to be here today to bring these two worlds together and hopefully provide an interesting format.
Thank you, Colby. Thank you, Irina, for having me. It is an absolute pleasure to speak about something that's not only in the news, but also in the hearts, minds, and souls of everybody, because it will affect our futures. And by that, I mean our money. I come from a similar background as Colby. However, on the other side, having worked over the past 20 years in various regulated environments, supporting businesses in Middle East, Asia, and here in Europe to build compliance ML frameworks and focusing a lot on regulatory compliance as that drives pretty much all regulated businesses. With Transak, we are building European more compliant operations because we have been operating through VASPN in Poland and now working to get our MiCA and PSD license in Austria and to support payments infrastructures and stablecoin payments from Europe to the world. I mean, in our case, it's from the US to the world, but giving EU a little bit more of a focal point. Thank you for having us and looking forward to today's conversation.
Thank you, Anamaria. And next, Emeka, please.
Yeah, hi, Irina. Thanks for having me. My name is Emeka Mgbenu. So unlike my fellow panelists, I'm more from like a technical side. So I've been a product manager for the past 8 years, primarily around fintech and regulated industries. Right now, I'm currently working with Sumsub, where my role is pretty much everything around building products and features that help crypto companies stay compliant. So that's everything from KYC to transaction monitoring to travel rule, whatever regulatory requirements that crypto companies are required to comply with pretty much lands on my desk to build. And yeah, happy to be here. Super excited for the discussion we're going to have.
Yeah, thanks, Emeka. So we have actually a strong mix of regulatory compliance and product expertise. across the crypto ecosystem. And together we offer today a 360-degree view from regulation and tax transparency to operational ML compliance to the technology enabling it all. So let's start with the big picture, right? Colby, from your perspective, what do CARF and DAC8 fundamentally change? Not just for the institutions, but for the end user. And tell us briefly about what is CARF and DAC8 for the audience as well.
Perfect. Thanks, Irina. Yeah, so very happy to be here discussing this today. Obviously, coming from the perspective of having, I guess, sat in the OECD in our conference rooms and working with governments to write these rules, and now at TaxBit, where we're basically providing the solutions to help crypto asset exchanges and different businesses, including financial institutions, come into compliance with these rules, right? And I think from that perspective, what we see today is that these types of requirements, which are traditionally thought of as tax reporting requirements, are actually much more similar to the types of financial crime or information reporting requirements that you would see in the AML world. And I think we can see that by getting into exactly what the details are, which I'll share with you very quickly here, but also thinking about the global scope of this framework, right? Where did this come from? Many governments around the world are obviously interested in the crypto asset space and the ability for that to be a main driver of their economies. At the same time, there's a concern that because the crypto asset space is inherently cross-border, it's very easy for someone to be sitting in one jurisdiction. For instance, I live in France, and I can sit in my living room, open my laptop, and I can be trading on an exchange that might be based in Singapore, and I may not even know that, right? And so from a perspective of both tax authorities and law enforcement, that information is basically sitting in a different jurisdiction than the one where I'm a resident. And so that obviously raises certain concerns and issues around compliance and enforceability. Now, just to provide everyone a bit of background before we dive into the more the fun parts of this discussion, when you'll hear from other people, not just myself, I wanted to set out why we think that this is actually an important thing to be talking about today. And really, I think the core of that is because of the global nature of these requirements. So here, what we see on this slide is there are over 70 jurisdictions that are set to come online with these requirements over the course of the next 2 years. So this year already, we have around nearly 50 jurisdictions that will come online with these requirements. So that means as of this year, in all the jurisdictions that are marked in turquoise here on this map, the crypto asset service providers in those jurisdictions are required to start collecting information on their clients in order to be able to report that information next year to tax authorities in the jurisdictions. So what's really key right now is many crypto asset service providers have to figure out, for purposes of this information reporting framework, where they're considered to be located, right? And because it may not always be as obvious as thinking that you have your offices in one jurisdiction, so you think you're located there, there's actually a very thorough set of rules and very prescriptive way in thinking about where you should be located. So that's basically looking at either your tax residence or place of incorporation, and if not that, place of management or place of business. So that's what a lot of service providers are currently doing right now, scoping where they need to come into compliance with these requirements. And then thinking about this as well in terms of, obviously, the turquoise countries here on this map are the ones that that have requirements starting this year, but the jurisdictions that are in dark blue will actually come online next year. So we see that this is very, very rapidly going to become a global standard, and it really doesn't matter where you'll be operating in terms of a key jurisdiction for the crypto asset community. You will be affected by these types of requirements. So what are we talking about when we talk about the crypto asset reporting framework, and what are the key requirements? I mean, here we can sort of sum it up into sort of 4 key building blocks, right? So first of all, what are the assets that fall into the scope of this? We're looking at crypto assets that have value. So it means that I can trade those assets, and then they have some sort of intrinsic value. This obviously covers payment tokens, but also investment tokens such as Bitcoin, as well as many types of stable coins or tokenized assets. Who needs to carry out these carry out this reporting and information collection requirements? Here we're looking at either intermediaries or individuals who carry out exchange transactions for their customers as a business, right? So if I am carrying out as a business, a service that allows my customers to exchange crypto to fiat or crypto to crypto, that's the type of activity that will get you scoped in under these requirements. Once I'm scoped in, what do I need to do? I need to identify my customers in line with AML KYC requirements, and then I need to top that up with additional tax relevant information that I need to collect. And I'll get into that in a second, exactly what those requirements are. And then finally, what is the information that's reported? Well, I've identified my customers, so I'll have to report the types of sort of customer identification information every year in the jurisdiction where I'm located. At the same time, what I'll also need to do is report all of the transactional information that these customers have encountered or engaged in over the course of the year, but aggregate those values up. So crypto to crypto trades, Ether to Bitcoin, Ether to Solana, et cetera, as well as any sort of Bitcoin to USD or any other types of crypto to fiat currency trades. Those would all need to be aggregated with those aggregated values broken out and then reported per customer every year. So when we're speaking about who comes into scope here, it's probably useful to also think of examples of who this is. Now, what's important to think about as well is that these requirements, and we'll get into this, I think, a bit more in this webinar, are very much tied to AML KYC definitions. So here we're looking very much at a similar definition than what exists under the FATF standards for virtual asset service providers. So we're looking at the types of entities that would fall in scope here are crypto asset exchanges, but also brokers and dealers who trade in crypto assets, crypto asset ATM companies, and then intermediaries who might be sitting in the middle between different types of wholesale purchases and sales of crypto assets. So what you can see here is that this is a very broad functional definition. And again, going back to those key attributes that I was mentioning earlier, exchanging crypto assets to crypto assets or to fiat currencies as a business, we'll scope in quite a few entities here. Now, finally, what are the sort of like key compliance obligations that we need to be concerned about here? I think the key thing to think about from the customer information collection perspective is that these requirements are very much tied to AML KYC, but they also have additional factors that I would imagine most companies in the digital asset space are not actually currently collecting for their customers. So these are tax relevant pieces of information that in many cases would not typically be collected as part of an AML framework. So what specifically are we talking about? The jurisdiction of tax residency of your users, their tax ID numbers, their date of birth, place of birth, and address. These types of pieces of information are often not collected. And what's very interesting to know as well is there are clear distinctions between things like jurisdiction of tax residency and the jurisdiction where I say I live currently. They may be different, there may be multiples. There's also the requirement here to identify controlling persons or the UBOs of entities who are your customers. And then you need to verify all of that information against the information that you have currently sitting in your systems from AML KYC purposes. Again, all this information for your customers needs to be reported alongside the aggregate transactions that are carried out over the reportable period. And that needs to start happening for those first sort of 50 jurisdictions that reporting would happen next year, and the information collection is already starting now. Hopefully that provides just a quick overview of sort of the key requirements that we're going to be talking about today, but hopefully we can get into this a bit more with the panel here directly.
Yeah, thanks, Colby, for this brief but still detailed intro. If we simplify this, what does this really mean for a crypto user, right? And what is the key takeaway for someone running a platform today, just briefly?
Yeah, exactly. So I think from a user's perspective, what it means is that there's going to be additional pieces of information that the platform I'm trading on is going to ask me about, right? And then what's also going to happen is that this information will get reported to the tax authorities of my home jurisdiction. So there's really two perspectives of it from that point of view. I think for the exchanges or for any business who has customers in this space, it's actually much more substantial, right? This is a serious requirement because it requires both this collection across all of your existing customer base and all new customers. So that actually implies developing an entire compliance framework. And then the requirements to report the transactional information also include very key elements around ensuring that pricing and formatting of data is done in a very consistent and harmonized manner in a way that may not always be the case across the entire digital asset ecosystem. So those are types of things that will have sort of fundamental changes, I think, to the way that many companies in this space will have to think about how they keep track of their customers' information and their transactions internally. And that's something that we see as well when we're working with companies to help provide them with the solutions to comply with these rules.
Right. So one thing that I find particularly interesting, that transparency is no longer optional. It's becoming embedded into how users interact with the platforms. And where do you think the biggest misunderstandings about CARF and DAC8 exist today?
Is it back to me again? I can jump in, and then maybe if others have any questions. But I mean, so I think really it goes back to how two things. One is how this is a global framework. This is simply not going to be something that companies or individuals will be able to escape this type of reporting because really so many countries around the world think this is a very critical, important type of rule that, as you said, Irina, is basically sort of like the sort of baseline rule in order to be considered a legitimate player in the space. So you can look at all the major crypto centers around the world. They all consider these rules to be non-negotiables on the same level as AML KYC rules. So I think that's the first key point to think about. And I think the other one is simply the fact that these types of rules are, as I mentioned, going to really change many ways in how businesses operate and how they have to both keep track of data, manage data, and then be able to report data.
Yeah, that's a really interesting point. And Anamaria, from the platform side, are users they actually aware of the level of transparency these frameworks introduce?
From my perspective, I think that depends because when we're looking at the jurisdictions which where traditionally users know and understand what tax is and how it applies and how it works, and we actually have jurisdictions in Europe where crypto tax reporting has been embedded through for quite a few years now, and I'm talking about Finland, I'm talking about France. I think this will be a natural progression because users not only know but also understand their obligations under the law. And in a way, the introduction of this framework will make it a little bit easier for them because then they will have a standardized reporting approach to reporting. When we're talking about the more gray areas and jurisdictions where users are not that friendly with tax, it will be a little bit of an exercise. And that is where education comes into play. And educating the user, explaining to the user what the reporting framework means, and obviously not only their obligations, but their liabilities if they fail to comply with their obligations under tax law in their jurisdiction of residence. And I would like to touch upon something Colby said, like home jurisdiction. Home jurisdiction and reporting in the home jurisdiction is done by the reporting CASP, where you conduct your transactions. However, and that is where the self-declaration comes into play, the user's declaration of what their tax jurisdiction is. If they transact, like Colby mentioned, on a exchange that is registered in Singapore, but they live in France, then users will need to understand, and that is where the CASPs and education comes into play, that the Singapore CASP will report the transactions of the French resident, and they will report them through this framework to the local enforcement agency or tax agency in France. So this is, and I think this feeds into a little bit the misconceptions that now everything is right there in front of us, in front of the tax authorities, and you said transparency. Where blockchain brought transparency, this is now cemented by what the CARF DAC8 framework intends to put in place.
True, thanks for that. I think also the key point to segregate those definitions. And Emeka, from a compliance identity perspective, do you see user behavior changing as this transparency increases?
Yeah, I would say definitely. I think from an operational standpoint, I think one of the things we've seen this year has just been, I guess, that drive from CASPs or VASPs to collect some form of data, right? So starting from like the TIN number or whatever like local reference that is in your jurisdiction. And that's like the basic level, right? But that is after obviously KYC, which every jurisdiction should be doing on behalf of whether it's individuals or businesses. And then that cascades into some of like Colby's earlier points, right? Understanding UBOs and how all of those things link. So there's definitely been that push from a data gathering perspective, from a KYC standpoint, from a transaction standpoint as well. There's also been the push, right? Because what happens operationally if you're a VASP is that you have all these different providers providing different services for you, right? So you have your on-ramps, you have your off-ramps, you have the internal transactions going on, and you need to be very sensitive about that data being stored centrally and being correct and being having some dollar value as at the time when the transaction was taking place, right? Because all of these things are data points that eventually you will be called upon to produce in some readable format to whoever your local regulatory authority is. So yes, there has been increased collation of that, both KYC data, like identifying data, and also the transaction data as well from my side.
Yeah, and if we move from theory to practice, what we're really seeing is a shift from account-based monitoring to user-based monitoring across ecosystems. So my next question to Anamaria, how does this actually translate into the user onboarding experience? Where do you see the biggest friction between compliance requirements and user expectations?
I mean, we clearly see a shift, and this comes from innovation in the entire across the entire financial sector, not only in crypto. And we see these digital wallets, we see integrations with national ID systems, and I'm referring now to the systems like the Estonian one, like the InfoSource certifications. So I think right now, and from our perspective, the service providers is being or understanding what the innovation is and where the shift is, especially in the context of digital identity. And working with that and working with solutions on the market, especially solutions provided by government authorities, because those are the easiest to be considering our obligations of identification and verification of the user, and those systems provide them because in some countries, for example, Austria, registration for ID Austria implies an in-person visit. So these are the backbone of the customer identification and verification. So from my perspective, it is a matter of understanding the tools that you're working with, understanding that the customer experience evolves and try to evolve with it as much as budgets, technological capability affords, and also educating the customer, because it's one thing to notify the customer essentially starting from the beginning of the year, just a quick notification, tax reporting obligations are coming into play. This will mean a few more details required from you, etc. And building that into the customer experience. So essentially them seeing that not necessarily every day that they come online, but when or at specific intermediaries, and try to build or integrate a seamless request for this additional information.
Yeah, thanks for this clarification as well on how users interact with platforms over the time, not just the onboarding. And Emeka, from KYC perspective, how are identity requirements evolving under these frameworks? Are we moving toward a more persistent user identity across platforms?
I think I would start with, like, from a vast perspective, internally, what we are seeing is, and that's kind of like what the trend has been, right? So KYC, anti-fraud, kind of like regulations have always been like increasing. There's been the need for like more information, address verification, and so on and so forth. And it's always a struggle because on one hand, users don't like to give out so much information. And on the other hand, VASPs or CASPs need as much information as they can, right? So understanding what the user is supposed to do, what he's earning, and so on and so forth. So one of the, again, shifts we're seeing is definitely collecting user information, a lot of that information upfront. There's also the questionnaire, which is what we call like the self-certification, where as a user, you're going to come in and say, XYZ, right? We're seeing that with the technology that we build, where CASPs or VASPs are using this to consolidate these data points, right? And then I think the advice of the trend that we see, especially with like mature CASPs, right, is they're trying to do this now. Like this law has been in place since January 1st. So now it's about the questions like internal teams are asking and should be asking is, is all my data correlated? Is it making sense? Is it in a place where it is data correct? And are we able to like verify like some of these data, right? And that's like a trend we're seeing from that perspective. On a deeper level, again, yes, we're talking about tax, but ultimately you can kind of marry that to the core essence of compliance, which is preventing like AML and assisting with like investigations. Those data points are also or can also be key indicators or key talking points, key decision data points that help when you have these investigations, or that help when you have to make a report. Okay, let's say a report or whatever the case may be, right? And there's a world where all of these agencies talk to each other and communicate. As a VASP, your role in that process is just to be as transparent as possible and have as much correct data as possible. So that's the goal. That's the trend that we're seeing, and that's something that we would like to encourage as well.
Thanks for that. So this is where things get particularly interesting. One of the most interesting developments is that tax reporting is no longer just a regulatory obligation. It's becoming, let's say, a source of investigative intelligence. And because we are seeing that the same data used for tax reporting is increasingly relevant for AML and investigations. Colby, how closely are tax reporting frameworks aligning with AML requirements today?
Yeah, I mean, it's a super interesting question. And I think this gets back to some of the points that both Anamaria and Emeka were mentioning here about, from a CASP's perspective, having to sort of walk these lines between user experience and being able to fully comply with these rules, because they're fairly complicated. But what really is important is to be able to actually have sort of those cross conversations in your data pools between tax information and AML information. Why is that? Well, basically, the types of identification information that are required under CARF is very much based on the AML KYC information that a VASP would already have for that customer. So that needs to be double checked. So let's say that you come to me now, I'm your customer, you're a VASP, you come to me and you ask me for some data for CARF purposes, for tax ID. Let's say that I give you an address that doesn't align with what I've reported under my AML KYC information. You need to be able to double check and cross check that information and flag that and say, oh, wait, okay, this is a red flag. Why is Colby giving me this information? I need to go back and confirm with him so that I can sort of update these sources internally and cross check that information. And that goes back to what Emeka was saying, right? Is eventually, when we think about this in sort of the downstream effects, right, a couple of years from now, once this reporting is actually live, once governments start receiving this type of information, it will generate significant amounts of investigative interest, I think, right? And what's really key is to be able to show that your systems internally are robust, that you've done the things that you need to do in order to fulfill your obligations. And if that's the case as a VASP, then I think you're in a great position. Now, I think if we think back to this in terms of how this information can be used across both AML and tax information reporting. I think it's important to think about how this information is all about cross-border activities of individuals, right? And in many law enforcement cases that deal in virtual assets often have a cross-border component. And what's very difficult a lot of times is being able to work with law enforcement authorities across borders, right? Having to go through mutual legal treaties and the different steps that it takes law enforcement to actually obtain information. Now, what CARF will do is it will actually allow for jurisdictions to receive significant amounts of data every year on their residents' activities outside of their borders, right? So I'm in France. I'm a law enforcement investigator. I'll see what my French citizens are doing, in Germany, in Italy, in Singapore, in terms of their virtual asset activities, and that can generate law enforcement investigations. It can generate tax investigations, and I think what we're seeing as well is, for instance, in the EU, DAC8, which is the implementation of CARF in the EU, has already allowed for the sort of pre-cleared this information from a tax perspective to be used for broader financial investigation uses as well, right? So authorities are already allowed to use this information for those types of investigations. And I think given the sort of cross-border nature of how crypto asset community is set up, you will see more and more interest from law enforcement authorities as we move forward.
So what we can say that tax reporting start functioning as an investigative signal, correct?
Absolutely. And one other thing that's really important, and this goes back to one of the misconceptions that people think about a lot of times when they think about the crypto space. I mean, not so much people who actually know crypto, but people from the outside, and they think, well, everything in crypto is on the blockchain, right? So why do we need a tax reporting requirement like this? Or why do we need AML because it's all on the blockchain? But in reality, we know that the vast majority of transactions actually occur in what we would consider an off-chain environment. So within a VASP or a CASP, right? And so that's really making that missing link, I think, for governments. That picture for them up until now has been fairly limited, and this will definitely open up those types of possibilities for their investigations teams.
Yeah. Anamaria, from an operational standpoint, how are internal teams adapting to this challenge? And are tax compliance and investigation still separate or becoming more integrated? So we can say that we effectively moving toward a unified user profile across systems.
I think that's a very broad conversation to have because of the internal setups of regulated institutions and obligations for AML and compliance. For example, throughout Europe with MiCA, pretty much all operating CASPs within the region have to have very, very specific setups for AML, compliance, tax, etc. That doesn't happen for certain types of CASP registrations in Switzerland, currently in the UK, etc. So it is a matter of how the CASPs organize their operations. Secondary, we're talking about first line, second line of defense, and where the first line of defense are the first guys that notice, that collect information, that process information, process data, etc. The second line of defense are the guys that actually look at what was provided, do the investigations, and try to identify any discrepancies or any issues. So I think it's a matter of how the organizations are set up. And I think because tax reporting, so tax evasion, will be reported by the second line of defense anyway, it is a matter of education internally as well, and training both first line and second line of defense on what this change will bring for the way how they look at customers and customer transactions. And I think a conversation with the data teams, data analytics, data intelligence teams is also warranted to make sure that data is sanitized and that the quality of data and the way data is structured is correctly done, so that we don't face, because CASPs are the first level level of contact in investigations by enforcement agencies so that we don't face these investigations and these inquiries from the tax agencies.
Yeah, thanks. Thanks about that. I think that actually links very well to the question of data as well. What Colby mentioned as well just before, that we cannot rely purely on the data. So my next question to Emeka, why is identity, which is off-chain data, so critical when interpreting blockchain activity?
Yeah, so I think I would start with just kind of like defining, and Colby did a good job of it, but I would just spend some more time on it, right? Like what exactly off-chain data is in this scenario, right? So off-chain data, first of all, is any transaction data that happens within your platform. So whether that's a swap, whether that's a perpetual trade, whether that's an on-ramp or an off-ramp, like conversion from one point to another, whether that's a transfer internally between two users in the same VASP, it's pretty much like off-chain, right? But that's on the transactional part. Also, there's also behavioral data, which is again off-chain, which is where again VASP should typically much be understanding, and this is more from an AML perspective, but understanding, just certain device data points, certain jurisdiction data points. So like VPN usage, transaction frequency, a lot of these other signals, like volumes of transactions in comparison to what the user is earning. There's multiple data points that can be combined to create a better picture of this user, right? And then you can now combine that with the on-chain data, which as travel rule becomes more and more popular, is a bit more de-anonymized, right? So as a VASP, you typically now know like what entities your clients are sending funds to and which exact individuals in those entities they're sending those funds to, right? So it's kind of like the combination of that, right? So you, on one hand, you have these data points that I've defined, and on the other hand, you have an intrinsic understanding of who the user is. Now, the goal as a VASP is to have the full picture of your user, like across board, like from day one, from onboarding to when they offboard, and then somewhere in between those lines, how you have to do reporting for them and how they grow with you, and so on and so forth. So that is why, in the full sense of reporting, if you don't have again these data points combined, you don't have like a key, a common key across board, like understanding this is the same user, and these are their patterns, and so on and so forth, then there would be issues, right? So that's like very, very critical, which is why, again, every VASP has to have that like complete picture, because you're taking some data points that may not have been connected in the past, and then you're joining that with the user's data. And in the event that you have to make a report, or you have to screen this user, or you have to check for some suspicious money muling, bad acting, then you can confidently say, to a large degree of confidence, that this is bad, this is good, let's make a report, or let's offboard this user, and so on and so forth.
Yeah, that's very critical, especially for some schemes such as manual schemes, right? When you link the off-chain identity to on-chain activity. So it's also for the both CARF reporting and AML monitoring remain incomplete if we don't have this link in between. And Anamaria, what challenges do platforms face when linking user identity with on-chain transactions, with on-chain behavior?
This is a very interesting question, actually, because like Emeka said, pointed out very nicely about the travel rule and more adoption. One of the requirements for the travel rule messages are those unique identifiers. And that theoretically is solved through customer IDs, wallet addresses, etc. However, I don't think that solves the issue. And this will be maybe a little bit better cleared up when we will implement the requirements of these frameworks through this tax identification numbers. I don't know if that's the solution. That could be the solution, but only practice will tell. Also, Emeka said very clearly that you don't have the same data. Even in your organization, you don't record the same data in the same way for different usages. And I remember we spoke not so long ago about dual use data, which is the data that we use for customer identification verification and and data that we use for tax reporting. So when it comes to data, there are so many challenges. We also have the regulatory challenges and the mismatch between in Europe the GDPR regulation and then the implementation for data protection regulation in other jurisdictions. So I think it's a matter of trying our best, the same that we see with the travel rule implementation of educating our customers so that as much as possible, they understand exactly what their obligations and liabilities are, and collecting as much data in the format that we internally can process and should process to ensure accurate reporting, and then work with it and try to improve it every step of the way.
Considering what you just told, right, about the fragmentation of the user identity, what are the risks if user identity remains fragmented across different services?
We can look at this from various angles. We can look at this from the liabilities and the obligations of reporting CASPs, and that can translate in incomplete reporting, scrutiny from the tax regulators, even penalties as something to be wary about. When we're looking at it from a user perspective, then it's over-reporting. It's double reporting. It may imply double taxation, errors. It may imply erroneous taxation. So because the user provided incomplete data or tax ID that is not the tax ID of the residence country, then it may be that they're wrongly reported and then they're taxed in the wrong jurisdiction. So that in itself can pose also financial risks and burdens on the users. Then we're talking about operational risks because we may end up having duplicate profiles or incomplete profiles. We are not able to do our risk scoring. We're not able to upload the reporting files because of errors in the reported data. So I think it's when we look at risks, we need to look at it from a holistic perspective and consider all of the elements to ensure that when we build our systems and internal collection and reporting frameworks, we have considered how the user, well, obviously how we are impacted, how the user is impacted, and how that translates into practice, essentially.
Right. So I think it's good shift to my next question for Colby. How important is data integration for accurate reporting on the CARF and DAC8?
Yeah, I think this is great because, I mean, Anamaria and Emeka were touching on some really important issues about that consistency across both the AML and tax information and the implications that can go wrong if you can't maintain that type of consistency. I think a great example of that is in the CARF. One of the reporting requirements under the CARF, we talked about at the beginning, sort of a lot of the main sort of transaction reporting requirements are on your trades between crypto assets and fiat currencies, right? So reporting those gains or losses over the course of the year. However, there's also a very important reporting requirement with respect to transfers. And here, this is a transfer. So let's say an outbound transfer or an inbound transfer to or from a VASP. And let's say that you do not know the counterparty. Now, what is your requirement in order to know who the counterparty is? Well, the CARF requires you to have implemented the travel rule and use the definition of the travel rules information to determine who your counterparty is. So I think this is a really great example of how your systems, when you're implementing systems to solve for this problem, they very much need to touch on both that tax relevant piece of information, but then also the AML piece of information, right? Because under the CARF, if you're able to identify who your counterparty is for that inbound transfer, it relieves you of that reporting obligation. However, if you identify that the transfer is perhaps inbound or outbound to a wallet who you do not know the owner of, that is an instance where you would then be required to actually report that information. So I think that's another good example of sort of these key elements that need to be kept in together in the same space. Beyond that, though, I think one of the key things as well, which I think I've already seen in a few of the comments here from the audience, is around eligibility for CARF reporting, right? So again, the CARF reporting is not necessarily, so it's for tax information purposes, but it's not necessarily dependent on whether that person is what we call like a tax exempt person or not. Instead, what it's based on is that person's jurisdiction of residence, and is that jurisdiction of residence a country that's implemented CARF, basically. And so that requires you as a service provider to actually be able to determine clearly out of your entire customer base, which of those customers are effectively reportable. So where's their tax residence? Where do they reside for tax purposes? And on that basis, should they actually be reported under CARF purposes? And I think Anamaria pointed out very well, like there's obviously serious implications if you get that information wrong, if the information goes to the false government, or if the implications of that could lead to problems for the customer. So those are the kinds of things that I think are really important when we think about making sure that the data is consistent across sort of the entire ecosystem of a service provider.
Yeah, I just have a look at the questions. We have quite a lot of them, right? So I'm just will try to make it very practical. I would like to ask each of you, if you had to prioritize one or two things, what should crypto businesses start doing today to prepare for CARF and DAC8?
My view will always be from a regulatory and requirement perspective. And it's very hard to marry that when our obligations are firstly to protect the business and obviously secondary, the customer's interests, etc. This, unfortunately, when we're coming to like, that saying, you cannot run away from taxes and death. This is pretty much that kind of situation. So in my view, and this is something that I've discussed with the tax authority here in Austria, customer education. So letting the customer know that this is coming, that this is not just another piece of news in the newspaper. This is something that is coming. It's impacting them, and it's here now. It's not going to be implemented in 2 years, the next year, etc. This is what needs to happen, and I think this is one of the most important things. Now, how do you do that without friction, without scaring your customers, without having customers drop out? That is the very fine line that we will have to walk. The other thing that I think is very important is preparation. Emeka spoke a lot about data, how to look at data, how to marry data, collect data. When I look at data collection, and the transformation that we need to do to both to the UX and the data systems and the data collection, I look at it as a Lego. That framework needs to be built in a way that it is flexible, that it allows for additional data points to be added in and analyzed. That's the most important, and analyzed correctly, which is again something that Emeka touched upon. Because if you do not have the correct data in the correct format and in the correct timelines, then you may be looking at a data mule problem, but you see maybe some sort of a tax evasion. So in my view, customer education and notification and keeping them up to date and informed, and secondary to that, or in addition to that, in parallel to that, building a sustainable framework, data framework.
What's your two things that businesses should prioritize to be prepared for the
I think from my perspective, Anamaria has raised some very important points about like education. So I would just segue off of that and say, from a vast perspective, the first thing is to kind of do like an audit, right? Understand what you have and what you don't have, and begin to now map out strategies to plug in those gaps, right? There's always a few tricks you can implement to get more data from customers. Expiring documents are a good entry point. Certain transaction thresholds are also a good entry point. Lots of different things, right? But you have to like audit your data, understand what you have, segment your customers, and then go after them in a sustainable way that doesn't, break the user flow. And again, coupled with like the education and all, helps them understand like why you need this data and for what reason, right? So that's like the first point, just like that audit. The second point I would say is definitely having one platform where I guess all your data points talk to each other. So one platform that has the full spectrum of who your user is, how they behave, what they earn, what jurisdictions they are in, their transactions, patterns, and so on and so forth. That helps because again, in a year's time, you don't want to be scrambling and importing and just like playing with Excel sheets. I mean, now AI can help, obviously, but you don't want to be doing that work with data from different sources that are formatted differently and that might have been collected for different reasons, right? So that would be my 2 cents on what VASPs can start doing like from today for the next 8 to 10 months.
That's really great one that data should talk to each other. And Colby, as well, two of or one of the things that should crypto businesses start doing today.
So I think, yeah. So, I mean, obviously, the first step is to figure out where you need to do your reporting, right? And do you fall into scope, right? And so that's very key because obviously these requirements are global in the sense that there's many jurisdictions around the world adopting them, but in reality, they're local, right? It's based on where you're actually a tax resident entity or where you have your main location. And that's where you need to actually build that relationship with the tax authority and understand what are the specific reporting requirements in that jurisdiction. Because from your perspective, at the end of the day, that's all that matters is the local reporting requirements in your jurisdiction where you're based. And that's what I would first understand is sort of, do you fall into scope? And then if yes, where and which jurisdiction should you be reporting? In many cases, we see that it can actually be multiple jurisdictions because this is an entity by entity approach. So it may be that you have different holdings and different spread across different regions around the world. And that means that you would actually have multiple separate types of reporting requirements for each of those entities. So that's something very important to scope. And the second thing I'd say is like once you've identified where you need to report and the fact that you do need to report, I would start collecting the information as soon as possible. One of the key lessons that I think that was learned from other similar frameworks, so like the CRS or FATCA, which were sort of the types of frameworks that were applied to traditional financial institutions, is that the financial institutions that took longer to comply had much more significant problems in terms of coming into compliance because they had to go back and rectify their accounts after they were potentially flagged for compliance issues. And it's much more difficult to do that than to start on the correct footing, have your data formatted in the correct way, and you demonstrate that you're able to track that data consistently as you start, as opposed to having to go back and do that later.
Yeah, that's two great ones, and I think that when we are moving to the questions from the audience, we have actually the ones which is about CRS and FATCA, and we have the question from Michael. Colby, feel free to answer. Can you explain the link between CARF and CRS FATCA and how CARF could bring VASPs into scope CRS and FATCA?
Yeah, it's an important question. So basically, alongside the development of CARF, there were also amendments that were made to CRS. So for those of us in the room who don't know, CRS or Common Reporting Standard and FATCA were sort of the sort of information reporting requirements for the traditional financial sector. Now, what's happened since the development of the CARF is that in parallel, certain amendments were made to the Common Reporting Standard. So basically, every jurisdiction that's implementing CARF will also have this updated Common Reporting Standard. very important for VASPs to be aware of this, because many of the types of assets that you would be required to report under CRS versus under CARF are the types of assets that you would actually probably be trading currently on your platform. So what will actually happen, I would imagine, 2 or 3 years from now, is that most VASPs will have to report under both CRS and under CARF. And it's very important because the reporting requirements are different. For CARF, we've talked about that. That's a transaction-based reporting requirement. But for CRS, it's an account balance reporting requirement. You report the account balance at the end of the year. And again, it really all goes back to the types of assets that are covered in scope of the new CRS. So that includes tokenized assets. It includes certain types of derivatives that are crypto, and it also includes many types of stable coins. More and more, I think stable coins will actually fall under scope of the CRS as opposed to in the CARF.
Yeah, thanks about that question. And we have another one from Nina Papajan. What if my business do not have a UI and not able to collect self-certificates from third-party app? I'm providing service on the terms on another business interface. So the question is that, can a third party collect the data on my behalf and then hand over it to me, let's say via API, or that won't qualify as a self-certificate collection?
The answer is yes. The answer is yes, but I mean, Emeka and Anamaria can come in, but the answer is absolutely yes. I mean, this is how at TaxBit, this is how we provide our solutions to a number of our clients, is via API and build that interface with their white labeled system. So it looks like it's coming from your own VAS, but we're basically that engine in the background that's doing the self-cert, that's doing the information collection and reporting. It's very much, I would say, a standard industry practice.
If I am required here, and the only thing that I can do is confirm, because we use the TaxBit system, and it's been very helpful, especially in the US, for the collection of data, or better yet, confirmation of the data already collected. So I can confirm that such a tool exists and it works.
So I think just be cautious of the time. All the rest of the questions, we will try to address them to our speakers. So we will share with them, I think, just right after the webinar. And as we wrap up, I would like to leave us with one key takeaway. CARF and DAC8 are not just about reporting, they are fundamentally reshaping how users are identified, monitored, and understood across the crypto ecosystems. Thank you again to our speakers. It was a brilliant conversation, live discussion, and to everyone who joined us today. I hope it was useful. Thanks.
Thank you.
Take care. Have a great day.
Thanks, guys.
Thank you.